welcome to India Decides, the FII View with me, Tanveer Gill. We're back again with another episode of the show that profiles global money managers and gets their view on India, given the global backdrop. My guest today on the show is Geoffrey Wong, who's head of global emerging markets and Asia-Pacific equities at UBS Global Asset Management. Geoffrey and his team manage over $22 billion of emerging market and Asia-dedicated funds. In fact, Geoffrey has the overall responsibility for all Asian, Japanese, and Australian equity teams, strategies, and research. This is Geoffrey's first interview to an Indian business channel. So, Geoffrey, thanks very much for taking out the time to speak with us. Let me begin by understanding your India view first. On macro factors, whether it's internal debt or external debt, which is essentially foreign debt, doesn't India look better than other emerging markets? Aren't India's leverage levels better than what you see across the region?
In some respects, India does look better. So external debt is really not an issue at all with India. And that's a very strong positive. Now, on the other hand, as we know, the internal debt of the government, the fiscal position, the fiscal deficit, that's structurally been a problem in India for a very long time. But this kind of the fiscal debt of the government is really something that does not need to lead to any short-term crisis. So we don't have any immediate worries about the fiscal position, although of course the country has to address that in the longer run. So yes, external debt is much better in India compared to other places.
Since you follow macro so closely, Geoffrey, when do you expect the rate cycle in India to turn, and how much of the inflation risk has reduced for the region? There is, of course, all that talk about a bad monsoon keeping food prices higher, and that could completely derail the expectation of a rate cut anytime soon.
In the short run, it will depend a lot on external factors. So internally, I think India, particularly the central bank, has established its credibility with its willingness to raise interest rates. We saw inflation spike up and then fall again. We're getting to the point where the weakness of the currency should roll off later in the year. So the year-on-year currency impact on inflation will be rolling off. So in that sense, those are positive things, and there will be a dependency on the monsoon, right? So if the monsoon turns out to be poor, and we have food inflation, that will end up being a problem for inflation. Now, if we assume that the monsoon is a normal monsoon, then our base case is that inflation will taper off over the year into the mid 7% range.
That's on the macro side then, Geoffrey. Do you think the Indian market, and I'm talking about the equity market now, at 15 times FY15 earnings, is at fair value? Could elections re-rate the market? Because that's the broad expectation.
So we're about at 15 times fiscal year 15 PE by consensus earnings. And that's pretty much around the midpoint of its fair value range. So I would say overall at this date, the Indian market is somewhat fairly valued. Now, if the election turned out to be what the market wants, i.e. a strong government returned, probably a BJP government, then there is no reason why the market shouldn't get to the upper end of its range. So it could go higher if we have a right election outcome. On the other hand, there is already a widespread assumption of a BJP victory. So if that does not pan out, there will be significant disappointment.
Geoffrey, I've been asking this to most of my guests, but as a buy-side analyst, how do you look at sell-side targets on the index? I'm sure a lot of these sell-side analysts, send out their reports to you as well. When they put out targets of 7,500, 8,000 plus on the index, on the Nifty, as a buy-side person who's looking to put in more money into the market, how do you look at these numbers?
Yeah, so the 75 to 8,000 range would put it at about 16 times PE, and again, that is maybe a little bit towards the upper end of its historical range. So, if the consensus is correct about a BJP victory and a clean majority, then certainly those target ranges are feasible.
A large portion of that up move for the markets would depend on the revival in the growth cycle in India. When do you expect growth to pick up?
Growth in India. India was one of the earliest Asian countries to get into this cycle. So it was one of the earliest to have problems with non-performing loans. Non-performing loans are rising quite a bit in the public sector unit banks. So in that sense, we feel that it'll be the first to exit from these issues as well. NPLs, while still rising, we think they are somewhat near their peak. Now, if the new government is able to release the projects that will actually improve the NPLs immediately and get investment going, in which case then the economy would bottom at that point, and that would be around 2015.
Okay, so how has your portfolio strategy been, Geoffrey? How has it changed since the start of 2014 for the Indian market?
At the point of 2013, we had some concerns about continuing weakness in the economy plus weakness in the currency. And at that point in time, the weakness in the currency in particular favored the exporters, so particularly the IT sector and the pharma sector. As we go into 2014, the focus more turns into domestic beneficiaries from basically this unlocking of capex, the unlocking of the projects. So domestic sectors such as financials become more interesting this year.
All right, Geoffrey, let's discuss your sector-specific investment ideas in India. Now, you like the IT space in India. I've seen that you hold Infosys in your disclosed portfolio. What did you make of the recent earnings that came out for all the IT majors, signaling a bit of a cautious view really for FY15 despite the recovery that we're seeing in the US?
Our view on Indian IT is quite independent of what will happen quarter to quarter. So we are not so concerned in the short run with some expected weakness. We feel that the underlying strength of the Indian IT sector is structural and long term. So since the global financial crisis, US corporations have underinvested in IT. So there is pent-up demand for IT, and whether it comes this quarter, next quarter, or into 2015 or 2016, to us it's still beneficial to the IT sector. And beyond that, we have demand potentially increasing in Europe and Japan as well. So we feel that it's more of a structural story rather than one that depends on year-to-year demand.
What about where do you see value in this market? Cyclicals like autos, auto ancillary, metals, cap goods, power infrastructure, these sectors that have been favored by the market. Have you taken exposure or increased exposure to these names or these sectors since Feb?
Yes, the auto sector continues to look interesting. That India is one of the underpenetrated markets for autos. The financial sector also begins to look interesting as the NPL cycle peaks and a new capex cycle begins. That would be very interesting for the financial sector also. Mid-caps and so forth are also very cheap if you're able to play those sectors. So the more cyclical sectors are beginning to look interesting in our view.
Geoffrey, what's your view on banks? There's, of course, that never-ending debate between private banks and public sector banks, also NBFCs. A few of them have got bank licenses. What's the overall view on the financial space then?
So the banking sector to us looks interesting because of, as I mentioned, we think the NPL cycle is near its peak and the capex cycle is beginning. So that looks fairly interesting. NBFCs, it's much more of a selective story. I think in certain areas such as second-hand vehicle financing and so forth, there are certain niches where a smaller NBFC can actually eke out a very profitable niche for itself. But if we look in general, NBFCs also have their challenges. They are now being more tightly regulated. They have certain obligations, so the obligations to lend into priority sectors, the need to build up a deposit-taking network and so forth. These are real challenges for the new licensed financial institutions. So I think it's very much a stock picking as far as the new financial institutions are concerned.
Geoffrey, another area of interest in the market right now is really the PSUs. And you can see that with the way the PSU ETF, which just recently got listed, the kind of interest it's generated and the way it's traded in the market. Do you concur that a new government could spell good news for PSUs or policy-sensitive sectors and thereby look at them favorably at this point?
In general, we continue to favor more the private sector companies, simply because the private sector companies have proven to be more nimble, generally more profitable. Now, to the extent that the new government is able to unlock projects in sectors, that's going to benefit both the PSU and private sector companies within those industries. So I think it goes across the board. Now, selectively, if there is a significant reform in the PSU, of course, that's positive. But until that happens, we continue to favor more the private sector companies.
Where do you believe for now, Geoffrey, where is it that the market is overvalued at this point? Is it farmers? Is it consumers? Where is it that you have booked profits?
Yes, consumer sector certainly is fairly expensive, and as the tide turns in the economy, the market may switch its interest into the more cyclical sectors, which would hurt consumer stocks. Now, pharma itself is not cheap, but again, I think it's very much a selective story.
Geoffrey, let's talk about your EM outlook. Let's begin by understanding your overall EM view. Now, you have stated that despite valuations looking cheap in emerging markets, and they being on the verge of a structural rebound, something that the market has been expecting for a while, there could be pressure seen on emerging market currencies going forward. What will lead to that pressure?
Right. Well, let me give a backdrop of where we think the emerging markets are. We believe we're at the tail end of a normal credit cycle. For example, in Indonesia, in India, we see that the current account is actually starting to turn less negative. So the response to a weaker currency as well as a slower economy is happening. So this is a natural part of the cycle. It's a good thing. It means that the beginning of the healing process has started. In a few other places like Turkey and Brazil, we actually don't yet see a good response from the current account. So for example, in the case of Turkey, about half of that current account is due to energy imports. And in the short term, the elasticity of energy demand to rising prices is not that high. So people in the short term do not adjust their energy consumption due to rising prices. So it's a bit stickier in those countries. But on the Asian portion, we actually see that the natural part of the cycle is evolving and we're heading towards a solution.
But what would that mean for the rupee, which has gained close to 11% from August lows last year?
Yeah, so the rupee has actually recovered quite a bit from the August lows. And we think India is one of the more successful countries in that respect. Now, we've had a rebuild of the balance of payments and the reserves. So the reserves are up about 25 billion to 300, which is quite a healthy amount. The central bank in India has also shown its credibility or demonstrated credibility by being willing to raise interest rates, and now has an image of being hawkish on inflation. In addition, they did very stringent moves on the curbing of gold imports. So we put all these things together. There's been a definite policy response from the Indian central bank and the Indian government, and that is perceived quite positively by the market. Now, it's important to note that a place like India actually doesn't have a foreign currency imbalance. So as such, the weakness of the currency is often due to the illiquidity of emerging market currencies. So when everyone decides to go to the exit door at the same time, obviously you can have very sharp currency moves, even though the underlying balances are not that bad.
Right, Geoffrey, I was going through one of your reports, and another interesting point that I picked up there is that bank credit to GDP ratios is higher than where it was in 1997 during the Asian crisis for all Asian economies at present. Does that make you a bit worried on the leverage situation in emerging markets? Yes,
bank credit has risen now. People reading the headlines, obviously they know all about China, the big buildup of credit within China, and that is a special issue in itself. But throughout Asia, bank credit has been rising quite rapidly. And again, this is a byproduct of the quantitative easing. Now, in quantitative easing, the developed market central banks decided to bring real interest rates down to zero, and they succeeded in doing that. Now, we can debate whether zero interest rates are appropriate for developed markets, but I think all of us will agree that zero real interest rates are completely wrong for emerging markets where GDP growth was still at 4 to 5% at that time. So in any case, we had zero real interest rates and GDP growth of 4 or 5%. And that, of course, leads to the natural buildup of credit. Now, this has happened throughout the region. In some places like Indonesia, we're talking about credit building up from a very low base. So the percentage growth in credit in places like Indonesia was rather high. But if we look at the absolute level of debt in Indonesia, it's not that high. On the other hand, absolute levels of debt in China, for example, are very high. So the big difference between now and 1997 is this buildup of debt is in local currency. So we've had a matching buildup of deposits And basically, banks have been lending those deposits out in local currency. Now, this has been true right up to the last year when certain banks in Singapore and Hong Kong have increased their lending into China, with a lot of that happening in US dollars. But if we take it as a whole, most of it is local currency. And that is a big difference with 97, 98. Now, what does that mean going forward? In 97, 98, because of the foreign currency borrowing and the fact what they call the original sin, right? We don't originate the US dollar. We can't print it in Asia or in the emerging markets. So since we have the sin of borrowing the currency we don't originate in, 97, 98 was a big crisis. This time around, you actually have the ability to actually print the money in order to pay back loans. Now, but the important point is that this time around, it need not lead into the kind of crisis that we had in 97, 98. However, it can be a bit of a drag, right? So these high debt levels will have to be restructured, have to be paid down, etc. And that will be a little bit of a drag on growth for some time going forward.
Right, but even though internal debt is a bit of an issue, Geoffrey, you've also highlighted in that report that external debt right now is at a decade low. So to that extent, has the correlation in markets reduced, within emerging markets that is? And with high local leverage and low foreign debt, how do you now evaluate the risk profile of emerging markets? Is it suffice to say that internal leverage is a bigger concern than external financing demand for a lot of these economies?
So the fact that we have internal leverage will mean that we will have slower GDP growth. Right? So this internal leverage, cash flow will have to go into paying down some of this internal leverage. And that cash flow, in the absence of that leverage, might have gone into extra investment. So in that sense, it will slow down the recovery, slow down investment, and so forth. However, because of the fact that it's internal debt and not foreign currency external debt, we don't have this kind of payment issues. So we don't have necessarily a collapse in the currencies in the cards, although currencies will probably be weakish on a forward-going basis.
Right, well, emerging markets look cheap relatively on a price-to-book basis, if you compare it to the MSCI World Indices, as also, the US benchmark especially. Return on equity in emerging markets have fallen drastically due to falling profits and dilution in equity. Wouldn't this be then the ideal time to increase investment in India and other emerging markets as you benefit both in terms of low value coming into these markets as they're trading at attractive price to book multiples, and also low return ratios that could benefit with a turn in the growth cycle?
Yes. Well, let's talk about the apparent cheapness of emerging markets and Asia. Actually, if we take a look at the overall index level, MSCI emerging markets, MSCI Asia, they're trading in the lowest third of their history. However, when we get into the details, almost all of that cheapness is being driven by China. China is selling at extremes of it, lows of its valuation. And within China itself, it's really driven by the financial sector, especially banks being a huge index weight, but also Chinese property. So we know that there are issues within that sector. If we take out the Chinese financial sector and take a look at the rest of MSCI Asia, then in fact, the majority of sectors, except energy, are actually trading around the middle of their range. So we have consumer staples, which are very expensive. Then all the rest, IT, industrials, and so forth, are around the middle. And then at the bottom, you have China, Chinese financials in particular. And also at the bottom, you have energy. And of course, energy has its own issues, the rising costs of extraction of oil, the fact that oil prices have not gone up, the shale revolution, and so forth. So looking into the details itself, MSCI Asia is not all that cheap, right? And probably correctly reflects some of the macro issues that I've been talking about. Now, with respect to India, India is also trading around the middle of its trading range. However, I think India is actually in more of a sweet spot with respect to investment. So India was actually the first country to go into this credit cycle that I've been talking about. So the buildup of credit happened. We've already had the NPLs rising, whereas in the other Asian countries, the NPLs have not yet started to rise. In India, they've been rising quite dramatically, especially in the PSU banks. Investment in India is basically at a decade low. We haven't had this low levels of fixed asset investment since 2003. Within the corporate sector, capex to sales is also at a decade low. So India is like a spring that's very depressed, right? We have extreme low levels of investment. We have extreme low levels of capex. Now, this is also tied into what's happening with government approvals. So we have a large number of projects which have basically been delayed for various reasons, environmental reasons and other reasons as well. And really those projects need to be released in order to solve these problems. So there's a nexus of issues which are related in India. We have the projects which are being delayed, and that is causing cash flow problems for companies, which is causing the NPLs to rise, particularly in the PSU banks, and is causing a slow economy. So the key to unlocking this nexus is really to get those projects growing. Right? Once you get the projects growing, the cash flow will start to appear, the loans will become good, your NPLs will become lower, and the fact that the projects are going mean that capex will go up and your GDP growth will go up as well. So India, while like the rest of the region, is also trading around the valuation, around the middle of its valuation range. The difference is it's closer towards the end or bottom of its cycle, and we think it's actually quite near the bottom of the cycle.
So then when do you expect growth to pick up in emerging markets? Which quarter of FY15 do you expect growth to pick up?
Yeah, I think it's very hard to tell the exact quarter. So, I would avoid being pinned to the exact quarter. But what I would say is that, the last major crisis cycle, 97, 98, took 5 years to really bottom. It bottomed around 2002, 2003. We are in a situation which is not a crisis per se, but really more of an end of a normal cycle, and all the imbalances of a normal cycle need to be worked through. So maybe it's not 5 years, maybe it's 3 years. So working backwards with a peaking in 2012 plus 3 years, that makes about 2015. So 2015 could be a good estimate of when earnings and GDP growth bottom. The markets themselves will typically react about a year ahead of that, so maybe late 2014 would be a good target for the bottom. But again, to pin down to the exact quarter is extremely difficult.
Geoffrey, it was great speaking to you. Thanks very much for taking out the time to share your insights on India and other emerging markets. With that, we of course come to the end of this edition of India Decides the FII View. Catch you with another special guest next week. Till then, take care.